Welcome to PortfolioCasts, the podcast where we break down real investor portfolios.
In this episode, we're exploring Chase Coleman from Tiger Global Management's portfolio, the key holdings, the concentration, and the thinking behind it.
Chase Coleman has built an absolute powerhouse with Tiger Global Management. We are looking at a portfolio valued at $32.2 billion today. It is a massive footprint in the tech world. Even with a slight dip of 0.41% today, the strategy remains crystal clear.
You are right, Sarah. Coleman is the quintessential growth investor. He focuses on disruptive technology and internet giants. Looking at the top of the list, Microsoft is currently his largest holding. It makes up 10.5% of the entire portfolio. That is a position worth over $3.17 billion.
That is a massive bet on one company. But interestingly, the portfolio is actually down 6.5% overall on Microsoft. Does that worry you from an analyst perspective?
It is definitely a point of tension. Microsoft is trading at $484.34 right now. The price-earnings ratio is sitting at 33.9. That is not cheap. But when you look at the 52-week range, it has been as high as $555. Coleman is likely looking at the long-term AI play here.
Speaking of AI, I saw some recent news about voice de-identification technology. Microsoft is a key player in that global market analysis. They are positioning themselves as the infrastructure for the next decade.
Exactly. And despite the current 6.5% loss, they are still paying a small dividend yield of 0.64%. It is not much, but it shows the company is maturing while still chasing massive growth. Coleman hasn't made any recent changes to this position. He is holding steady with over 6.5 million shares.
Let's shift to the second largest holding, Alphabet. This one has been a huge winner for Tiger Global. They are up 32.4% on this position overall.
Alphabet is a foundational piece for Coleman. It accounts for 8% of the total portfolio. That is roughly $3.42 billion in value. The stock is trading at $321.77. It saw a nice jump of 2.4% just today.
I noticed the price-to-earnings ratio is a bit lower than Microsoft's. It is sitting at 30.5. Does that make it a better value play in this high-growth sector?
In many ways, yes. Alphabet has an earnings per share of $10 even. They also recently started a small dividend of 0.27%. The technicals look strong too. It is trading near the top of its 52-week range, which goes up to $328.
There was also some interesting news regarding Alphabet's ecosystem. Semaphore just hit a $330 million valuation in a fundraise. This is fueling global expansion. Alphabet is always at the center of these digital media and data shifts.
It really is. Coleman owns over 10.6 million shares of Alphabet. He hasn't touched the position recently. He seems very comfortable letting the 32% gain ride. It provides a great cushion for the portfolio.
Now let's talk about Amazon. This is the third pillar of the top holdings. It makes up 7.5% of the portfolio. What caught my eye here is that Coleman actually added to this position recently.
He did. He increased the stake by 3.35%. That brings the total position to over 11 million shares. It is worth about $2.67 billion. Amazon is trading at $242.07.
The gain on Amazon is solid too. They are up 10.2% overall. But the price-to-earnings ratio is quite high at 33.7.
It is high. But Amazon is always a story of reinvestment. Their earnings per share stands at $7.08. The stock has been on a tear. Its 52-week low was down at $161. Now it is flirting with that $258 high.
I saw a headline comparing Amazon to UPS recently. It suggested that if you own UPS, you should look at Amazon instead. It highlights how Amazon is eating the logistics world.
Coleman clearly agrees with that sentiment. By adding 3% to his position, he is signaling that he thinks there is more room to run. He is not just holding these tech giants. He is actively leaning into the ones he thinks have the most momentum.
It is a very concentrated top three. Between Microsoft, Alphabet, and Amazon, you have 26% of a $32 billion fund. That is a lot of eggs in three very large baskets.
It is the Tiger Global way. They don't diversify for the sake of it. They find the winners and they stay aggressive. When you look at the total portfolio loss of 0.6%, it is remarkably stable. That is because these big three are doing the heavy lifting.
The Microsoft loss is the only real blemish in this top group. But even there, the scale of the position shows Coleman's conviction. He is waiting for the AI cycle to reflect in a share price.
And he has the capital to wait. With $32 billion under management, he isn't forced to exit positions early. He can weather a 6% dip in Microsoft because he is up 32% in Alphabet. It is a balanced approach to high conviction growth.
We've seen the heavy hitters in the top of the portfolio. But Mike, I want to look at the rest of this $32.2 billion machine. Specifically, C Limited. It is a massive 8.9% of the total portfolio.
It is their second largest position, Sarah. They hold over 16 million shares worth $2.2 billion. It's been a bit of a rough ride, though. They are down nearly 22% on this position overall.
And the stock was down over 2% just today. What are the fundamentals looking like there?
The price-earnings ratio is sitting at 58.3. The 52-week range is wide, from $99.50 up to nearly $200. Right now, it's trading at $139.67. It's a volatile e-commerce and gaming play in Southeast Asia.
Let's shift to the semiconductor space. We can't talk about tech without NVDA and Taiwan Semiconductor.
Exactly. NVIDIA is 6.8% of the portfolio. That is $2.2 billion in value. They haven't made any recent changes to the position size. It's a core holding for Chase Coleman.
It's interesting because NVIDIA is actually up for them, even if it's just a 1.2% gain overall.
It's a steady hand in the portfolio. The P/E ratio is 45.9. It's trading at $188.85. That is toward the high end of its 52-week range. Meanwhile, Taiwan Semiconductor makes up 4% of the portfolio. They are up over 14% on that one.
I noticed a huge move in Meta Platforms. They reduced the position by over 62% recently. That is a massive exit.
It really is. They still hold $1.8 billion worth of Meta. But cutting 62% tells me they are taking profits. The stock has a PUE of 28.4. They are actually down 11.6% on the remaining entry price.
Do you think they are rotating that money into other AI plays? I see they added to Broadcom and GE Vernova.
It looks like a rotation. They added nearly 7% to Broadcom, which is now a $995 million position. And GE Vernova was a 5% add. That's a $770 million stake. GE Vernova has a very high PE of 109.3. It shows Coleman is willing to pay for growth in the energy sector.
We also have to talk about Reddit. They trimmed the position by 24%. But the stock is still a winner for them, right?
Very much so. They are up 12.5% on Reddit. It's worth $1.2 billion in the portfolio. The PE is sky high at 137.7. It's a classic aggressive growth play that has performed well since the IPO.
On the flip side, AppLovin is a 4.5% allocation. But they are down 11.5% on it.
AppLovin has been volatile. It's trading at $635.59. The PE is 73.7. It's a big bet on mobile advertising and AI. It's currently worth about $1.2 billion to Tiger Global.
I'm looking at some of their smaller, newer moves. They actually started buying Netflix and MongoDB recently.
Those are interesting buy signals. The Netflix position is about $183 million. They are down 24% on it so far. It's trading at $91.03. MongoDB is a smaller 0.3% allocation, but they are already up 42% on that one.
That is a huge gain for a new position. What about the fintech side of things? I see Block and Corpay.
They are leaning into fintech. They added 12% to Block, also known as Square. That's a $318 million position. They also added nearly 18% to Corpay. Corpay is a $565 million holding. It has a much more reasonable PE of 21.1.
It seems like Coleman is balancing these high-flying tech names with some value. Look at United Health Group. It's a $150 million position.
Yes, and a PE of only 18. It also offers a 2.5% dividend yield. It's a defensive play in a very aggressive portfolio. The same goes for Apollo Global Management. That's a $900 million position. They are up 9% on that one.
As we wrap up this look at Tiger Global, what is your biggest takeaway, Mike?
Chase Coleman is clearly doubling down on the infrastructure of the future. He's holding the line on semiconductors like Lam Research and Applied Materials. Both of those are huge winners for him. He's up 52% on Lam Research
and 42% on Applied Materials. Those are home runs.
They really are. Even with some losses in names like C Limited and Grab, the winners are massive. This portfolio is built for a world where AI and digital platforms dominate. He isn't afraid of high PE ratios if the growth is there.
It's a $32 billion bet on the next decade of innovation. From Reddit to Taiwan Semi, the footprint is global.
It's a masterclass in high-conviction growth investing. He trims what's expensive, like Meta and Reddit. Then he rotates into the next big thing.
That is a perfect place to end our deep dive into Tiger Global Management. I'm Sarah.
And I'm Mike. Thanks for joining us on this portfolio breakdown.
We will see you next time for more expert analysis. Have a great trading day. Thanks for listening to PortfolioCasts.
This content is for educational purposes only and should not be considered financial advice.
Any figures, prices, or portfolio values discussed are approximate and used for illustrative purposes only.
Follow PortfolioCasts for more investor portfolio breakdowns.